In today's episode, I'm going to reveal an advanced scalping strategy that combines the Ichimoku cloud with the Fibonacci retracement. Basically, a powerful mix of price action and indicator-based trading. And the best part, you can apply this setup on any asset, in any market, and on any time frame. Though, of course, the lower the time frame, the more opportunities you will spot. Make sure you study this setup carefully, because mastering it can seriously level up your trading game. Now, the very first step is to bring up the Fibonacci retracement tool. Head over to the Tools section on TradingView, select Fibonacci retracement. Click on your chart and drag it all the way down and to the right. That's all. Now, the default Fibonacci settings can look a bit messy, so let's clean them up. Double-click on the Fibonacci. Keep levels 0, 1, 0.382, and 0.23. Then uncheck everything else and add two new levels, minus 0.27 and minus 1.27. Everything beyond this point is optional, but if you want your chart to look exactly like mine, feel free to follow the rest of my steps. So finally, this is the magical Fibonacci tool we're going to use today. To fully understand this strategy, we need to walk through a couple of key concepts. Take a look at this uptrend. Price has moved higher, and then we get what we know as a base or an exhaustion. When we apply the Fibonacci retracement, notice how the candles react to 0.23 level. And here is why that matters. The zone between 0 and 0.38 is the strongest Fibonacci regions. If price retraces into this area, then there is a significantly higher probability that it will continue pushing up toward the higher Fibonacci levels, and sometimes it happens very aggressively. Now let's analyze this smaller downtrend. I apply Fibonacci retracement. And again, you can clearly see price reacting to 0.38 level. So just like before, this zone acts as a powerful Fibonacci area. In this scenario, we would expect the candles to likely continue moving down toward the lower Fibonacci levels. Now let me show you one simple but incredibly important point that can help you not only with this strategy but with almost any strategy you use. On this chart, after an uptrend, the candles start pulling back. But notice what happens at the end of the move. Price pushes up and creates a new high, or at least a higher high relative to the previous one. From a pure price action perspective, that is crucial, so this higher high often signals reversal, and the candles may start moving upward again from this point on. So when we apply Fibonacci retracement, your first click must be at the beginning of that upward rally, and your second click at the end of it. But here's the game-changing part. The end of the trend should be placed on minus 0.27 and not 0 like the classic Fibonacci methods. This single adjustment can completely transform the way Fibonacci aligns with the real market behavior. You can see the rejection from the 0.23 level, and that gives us a strong probability that candles may continue pushing upward to the minus 1.27 level. Now that you understand how we're using Fibonacci, let's move on to the second part, where the Ichimoku cloud steps in and elevates this strategy to another level. So on your TradingView chart, head over to the Indicators tab and type in Ichimoku cloud. Click on it, and it will appear on your chart in its default form. Now let's make a few quick modifications. Open the indicator settings, go to the inputs, and set the leading span B length to 108. Then switch to the Styles tab. Keep the conversion line, the baseline, and of course, the cloud itself, but you can uncheck the rest to keep the chart clean and completely focused. The Ichimoku gives us incredibly valuable data. Its cloud, whether it's blue or red, acts as a strong dynamic support and resistance zone. And the two trend-following lines, the conversion line and the baseline, are essentially momentum and trend direction indicators. They can provide powerful insights for timing your entries, and you're about to see exactly why. Watch what happens when the candles break out of the cloud. Just like in this example, this kind of breakout can signal an opportunity because a major support zone has been breached. Once that breakout occurs, notice how the conversion line and baseline start following the trend. All the data aligns, suggesting that this downward move has a strong chance of continuing. Now here's an important point. When candles get stuck inside the Ichimoku cloud and fail to break through it, price may simply continue moving in the same direction. In other words, it becomes a trend continuation signal. You can see clearly on the chart. The candles stay above the cloud and both Ichimoku lines are moving in harmony with the trend. So from this point, we can reasonably expect a probable upward move to follow. Now let's combine everything we have learned and build this unique scalping strategy that can genuinely strengthen your trading portfolio. Take a look at this uptrend. Step 1 is simple, just apply the Fibonacci retracement. We can clearly see a rejection from the 0.38 level. Bring up the Ichimoku cloud. Just notice how the Fibonacci zones sit inside the cloud. This tells us that price action within that area is extremely strong, and that rejection from 0.38 becomes much more meaningful with a higher probability of holding. So our entry point comes when the price breaks above the 0.27 level. And once that breakout happens, I enter a trade, set my stop loss in a suitable position, and place my take profit on minus 1.27. And as you can see, this setup results in a clean, successful trade. To aim for even more potential continuation, I can add one extra Fibonacci level. So in Fibonacci settings, I add minus 2.27, which helps capture those extended legs when the trend really starts pushing. Watch this short example on your US dollar 1-minute time frame. Look at this sharp downward dump. I apply Fibonacci retracement on this trend, and once again, you can see that Fibonacci zones are sitting inside the Ichimoku cloud. This alone is a strong indication that the rejection from 0.38 is likely valid, giving us a high probability continuation to the downside. So now you have learned a powerful scalping strategy that blends price action with indicator insights. But before you go, you have to consider that I'm not a financial advisor, and this is not a financial advice. All content, information, and opinions shared in this video are for educational and entertainment purpose only. Trading involves risk. Make sure you consult a professional before taking any financial decisions.